you're watching Context TV, coming to you from Context Summits West. I'm Michelle McCory, and with me is Guy Adami from CNBC Fast Money. Commercial litigation funding took hold in the US about a decade ago, and now litigation finance is making big headlines, with several firms wanting to get in on the huge Equifax data breach and the potential lawsuits. So what is litigation finance, and why is it controversial in our already litigious society? To discuss, we're joined by Alexander Chucri. He's the CEO of Pravati Capital, which provides collateralized asset-backed bridge capital investments into the litigation finance space. Good to have you with us, Alex.
Thanks for having me.
Now, Alex, firstly, break it down for us. What exactly is litigation finance?
So we provide capital into the legal markets, and we look at it as three different asset classes. Your consumer that has been in a situation where there's a product breach, or there's in the commercial side where we actually finance a law firm as a typical lending facility to help them bridge their capital. Typically, it takes firms quite a while to settle suits, so we help bridge and even out that gap. On the commercial side, we do finance commercials or commercial entities that have been either lost their intellectual property rights or have had a breach of contract or something along those lines. So we provide a stable assortment of capital to that industry.
Now, we heard a lot about this concept of other people paying for other people's lawsuits with Peter Thiel when he helped Hulk Hogan sue Gawker. But beyond personally motivated cases, how common is litigation financing?
Well, it's common. I mean, the Thiel situation was, lack of a better word, a revenge type situation, right. I think. And out of a lot of the black eyes in our space, I think that was one of them. But I don't know of any funders that do this for a living are looking for that type of return.
How do you guys get paid? And what I guess my question is, law firms typically take a third of a settlement. Do you get a percentage of that third? Is it a flat fee?
It's a flat fee. It's like a hard money loan. So on a piece of real estate, you have a hard money loan. It's very similar to that, but these are non-recourse advances. So if the firm does not perform, we don't get paid.
So how similar is this to other private equity plays?
I think it's, if you look at the direct lending space, I think it's very similar to that, in that we are financing cash flow for a firm, or we're financing expenses for a firm as it pertains to one particular case.
And this seems to be very uncorrelated, right, to the rest of the market?
It's absolutely uncorrelated. I wrote it through 2008, 2009. There wasn't any bumps in collections. In fact, there was more capital being offered at the time.
My question would be, do you pick and choose the law firms case by case? Is it typically the smaller firms that you service, or do you do big firms out of New York City?
We're seeing big firms. We're seeing obviously the smaller firms on a entrepreneurial basis. We're seeing them needing capital to grow. We tend to fund the entire firm, so we have all their cases. We look at every single case and we provide a loan to value that's extremely low. And but our methodology is everything is highly diversified in pools of fund with very significant concentration limits, so there's no binary type reaction to like some of your big mass tort cases.
So you fund every single case of a particular law firm? There's no cases that you would avoid?
We want to do that. We want to have a cushion, because we know that some of them are going to go bad.
Right.
We've done 5,000 one-off cases where you invest money into one case. We're doing a lot more on the portfolio side, but we have extremely low loan to values, and we're cautious about it. And we're in the business to be the David and Goliath story. That's what our focus is.
Do you run into any problems with lawyer-client privilege stuff, or is there a wall effectively between you and the client?
The attorney-client privilege is somewhat given up when you take any information to give it to a third party. So we are very cautious about the kind of data that we do get. But we know enough about it on the portfolio side. We don't dig into every single case to a level, but we know the ones that we're going to stay away from.
Now, foes of litigation finance say that it just makes more lawsuits, makes things more distracting, more expensive. One of those foes is the U.S. Chamber of Commerce, and they're looking at potentially regulating the space. How concerned are you about that?
You know what, they've been at that for a while now. So I participate in a lot of the legislative aspects of this I've been doing this for 17 years. And we've seen this movement, and it's to protect insurance rights. We think that, you know what, this is a business model that really helps a client get what his case merits. There is statistics through the association, the American Legal Finance Association, that shows that suits have come down in the last 5 years. Some of your biggest firms in the country, there's been a decrease in the size of firms, decrease in the size of the amount of fees that firms charge. So we're seeing the marketplace. You would think that as capital gets into it, it's going to further it, but we haven't seen that. Look, nobody wants to finance a frivolous suit. That is very well vetted out in our underwriting process to make sure that we're not doing those types of things.
So the other side of this coin is, and I'm sure you'd agree with this, you're leveling the playing field in a lot of ways.
That's the whole motto. It's a David and Goliath story. We're leveling the playing field. I can cite numerous situations where somebody's come to us, whether it be a corporation or an individual that is a construction worker that just got hurt badly in a car accident and can't work. I see it from a businessman's perspective. I see it from an insurance point. If I'm running an insurance company, I'm going to make sure every claim is right. And I'm going to try to beat down that claim. But on the other side of it, that person should get what the case merits. So we finance that piece.
Now, you're not a lawyer.
No.
And you don't have to be a lawyer to be involved in this kind of fund.
No.
So what is your outlook long term? You're not concerned about potential regulation. What's your outlook then?
Well, I think this is going to be a continual niche business. I think that our biggest headwind is educating the law firms about this. We go into more law firms that have never heard of this. And once we explain it to them that this frees up their cash flow or provides them cash flow, it's a fairly reasonable solution for them.
How do you select the law firms?
It's just a sales strategy, right? You're going into firms, you're discussing obviously we're looking at their cases. If a firm goes out and says, "Oh, I have 20 cases and it's worth $100 million," and we dissect it and it's worth $3 million, that's a big question mark, right? How they're overvaluating it's no different than this movement with direct lending into businesses. It's a level of underwriting.
Final thoughts, Guy?
Final thoughts are, it's fascinating. I do think you're leveling the playing field, and it's, in terms of alternative assets, is zero correlation, I would imagine, to the market. So in that regard, my sense is it could be a really growing area for you. And who are your competitors, quickly?
We have a couple competitors that have assets in the multi-billion-dollar range that are publicly held. And then there's a lot of smaller. Some people will focus just on consumer-oriented things. We tend to focus on all of them. We just if it's a good case, we'll take a look at it.
All right. Thanks so much. I guess
thank you for your time.
We'll see you in court.
Alex,
thanks so much. And of course, Guy Adami from CNBC Fast Money. And I'm Michelle McCory. You're watching Context TV.